This is The Chris Berry Show. Expert information on elder law, retirement, and estate planning. Information that you can understand. Here's your host, Chris Berry.
Welcome to The Chris Berry Show. This is your host, Chris Berry, where every Sunday at 2 p.m. we talk wealth, estate, and tax planning for the second half of life. And this week, I'm pretty excited to start talking about a concept of financial planning called the bucket plan, where we'll talk about how to handle your finances in that second half of retirement, how to protect against sequence of return risk. So I'm very excited to talk about that in our second segment. Then on our third segment, every week, we'll answer your questions. So our listeners, if you do have questions, you can submit questions anytime at askchris@thechrisberryshow.com or give us a call anytime at 810-355-2584. And some of those listener questions we'll take a moment to answer on air. And so I always like to start the show off with a positive focus, something exciting that happened within the past week or something to feel positive about. And for me, this past week, one of the most exciting things that happened was that my wife, my kids, and actually my wife's parents, we went to see the Star Wars costume at a Star Wars costume show at the DIA, Detroit Institute of Arts. So it was great seeing all of the different costumes. And these were the actual costumes that the actors wore while they were filming the Star Wars franchise. And me being a big Star Wars nerd, I'm a huge fan of Star Wars. It's been a part of my life ever since seeing the first Star Wars as a young kid. And then it's been something that's been great to share with my family, and especially my son Ryan. He's really into Star Wars right now. He's about to turn 8, but one of the things we like to do is little Star Wars quizzes where we will quiz each other on just a level of knowledge we have with regards to Star Wars. And he has some Star Wars encyclopedia books that when he's going to bed, he reads before falling asleep. So he's pretty knowledgeable, and he's watched some of the other canon, some of the other, there's a Star Wars cartoon, so he has a little bit more knowledge, actually, than I do. I rely more on the movies. I know more about the Star Wars movies than he does, but it was great to share that with him. And also, it was interesting just learning how George Lucas and the designers looked at creating these different costumes. A lot of thought put into it, where they were trying to convey certain moods, certain theories, drawing upon different cultures for these different costumes, whether it was a Princess Padme or was it the Emperor. And just by looking at the costume, you can kind of get a feel for who that character is, or Obi-Wan Kenobi or Anakin Skywalker. They had very unique costumes. So it was pretty interesting seeing how they put all of this together and how just from the creative spark of George Lucas's mind that they fleshed out this whole universe. And just looking at it from the perspective of the costumes, it was really interesting seeing or doing a deep dive in this little niche area of the Star Wars universe, just seeing how they went through these different costumes. And I got into some interesting, it was interesting because they had an adult track as well as a kids track. And with the adult track, it got into some interesting concepts. For example, how Carrie Fisher gave some advice to Natalie Portman in terms of how they allowed the costumes to develop. If you remember, Princess Leia had that bikini as part of the Jabba the Hutt scenes. I don't know if you're a big Star Wars nerd like me, but most people remember that. And how Natalie Portman's role as a woman looked very different than Carrie Fisher's. So it touched on some interesting themes, but it was great just sharing that deep dive Star Wars knowledge experience with my family and kids. So that was my positive focus. And then July 4th is coming up. So I'm sure, I hope you have a wonderful July 4th. It's always important, Independence Day. I know we're going to be grilling on my new Traeger grill. Did some cooking this weekend with it, made some great hamburgers. We might do some ribs on 4th of July. And then I live on a lake, and so we're going to watch some fireworks. So it's pretty exciting, and I love sharing it with family. And then also something that was kind of interesting this weekend is my wife's father came into town, and he was a retired financial planner. So him and I, we got into a discussion where I was talking shop. But one of the things we were talking about was the difference between when he was practicing versus how things are now. So we were talking about the old paradigm versus the new paradigm. And so I thought it'd be interesting to share some of the things that we talked about. For example, the first thing with the old paradigm is that you worked for the same company your whole career. For example, my father, he worked for Oakland Community College. He was a college professor for, I want to say, 47 years, so that long with one company. Now, you compare this to the new paradigm, and I looked at this statistic that the average person now works for 7 different companies during their career. So it's very different, and a lot of times we see people leaving 401ks at old companies, which may or may not be a good idea. Then with regards to old paradigm, most people retire at 65, claim their Medicare, and receive a pension. Well, these days, not a lot of people have those pensions. Instead, it's the 401k has replaced the pension for many individuals. We see pensions kind of going away, which is interesting because it puts more onus on the individual, puts more responsibility on the individual, gives the individual more control. So what that means is we need to be more educated about how we are going to manage our retirement because we don't see a lot of these pensions. Pensions are pretty much set it and forget. Then still talking about that old paradigm, relying on Social Security for supplemental income. The new paradigm is retirement money is typically self-funded. I think for the average American, I looked up the statistic that Social Security only makes up 40% of the average American's income in retirement. So it puts more onus on us as the individual investor to manage that remaining 60%. Then still talking about the old paradigm, less emphasis on one's own investments. And the new paradigm, Social Security may cover very little of the lifestyle requirements. So again, a lot of it is now putting more responsibility on the individual investor to manage their finances because these pensions are going away. Social Security benefits, they're there, but they just make a small piece or just a piece of the puzzle when it comes to retirement planning. And then fifth, investments paid for supplemental retirement needs only versus the new paradigm. Some never fully retire but choose to stay engaged at some level. So with the old paradigm, basically you would, as soon as you retired, you were done and you just live off of your large pension, your Social Security, and then just use your investments as supplemental income. But what we've seen with this new paradigm is that with these pensions going away, and depending on how you manage those 401ks and IRAs and the rest of your investments, that's going to determine how your retirement is going to look in terms of what your lifestyle will be and your lifestyle expenses. And what some people find is that either by choice or by need, that they have to take on some type of part-time work. And that's different for everybody. Some people, they like to stay engaged. For example, when my father officially retired, he still went back as an adjunct professor and taught some classes because that's what he loved to do. And then I have other clients who work in IT or they do some type of consulting in retirement. But it's kind of a switch between the old paradigm and the new paradigm. So we had an interesting conversation regarding that. And one of the things that, kind of to summarize that, is that it really does put more emphasis on making your individual choices in retirement. And so you have to be very knowledgeable. And that's one of the reasons that we put together the Chris Berry Show, is that our firm, we believe in providing our clients as much knowledge as possible so that they can make great decisions with regards to their estate planning, with regards to their tax planning, and with regards to their financial planning. And it's important to understand that there's a lot of information out there. And the key to it is to understand, how does this information pertain to me? So that's one of the reasons that we host weekly workshops on a variety of different topics. So usually I'm I have 2 to 3 speaking engagements per week where we try to provide education to clients and the public on wealth, estate, and tax planning. And if you want to learn more about any of those workshops, please visit our website at thechrisberryshow.com. Again, thechrisberryshow.com. And usually we have these workshops throughout Southeast Michigan, the Metro Detroit area. Usually at one of our locations in Bloomfield Hills, Livonia, Novi, or Brighton, or at some other location in the Metro Detroit area. So if you do want more information on one of our workshops where we cover these different topics, please visit thechrisberryshow.com, and you can find out some more information there. And then while you're still there at thechrisberryshow.com, feel free to take a second. And this last month, the month of June, was Alzheimer's Awareness Month. And so we spent a lot of time talking about Alzheimer's last month and the effect it can have on individuals, on your quality of life, and on your assets. And so we talked about asset-based long-term care and legal steps to take if you do have a loved one with Alzheimer's. But while you're on our website at thechrisberryshow.com, feel free to click the link where you can help contribute to the Walk to End Alzheimer's. Where every year we organize, we're part of the committee that organizes the Walk to End Alzheimer's, one of the 600 different walks in the state of Michigan. Last year, our walk raised over $137,000 to fight Alzheimer's, which is a form of dementia that's affected family members, affected many of my clients. So it's something we're very passionate about. So last year, we raised over $137,000 to help fight Alzheimer's as a committee. And then our firm alone, we were the largest fundraising team for our walk. We raised over $11,000 last year. And the walk overall, our walk, we had over 800 walkers at our walk. So we're pretty excited about that. We shut down Main Street and we had 800 strong walking to fight Alzheimer's. And then this year so far, the walk, we've raised over $3,000 so far. Actually, $3,600 we've raised so far. And the walk is going to be September 29th, and registration opens at 9 a.m., and the walk is going to be at 10:45. And this year, we're really hoping to get over 1,000 walkers. So if you do want to participate in that walk, please visit our website, go to thechrisberryshow.com, and you'll see a link that'll take you to the Alzheimer's Walk page. And if you're busy on September 29th and you can't make it, then maybe you could at least donate some money to the cause. Even if it was $5, the price of a Starbucks, every little bit helps, because we want to try to stamp out Alzheimer's so that it's not something that our loved ones have to deal with in the future. So if you do want to help contribute to the cause, please visit our website, thechrisberryshow.com. Now, something interesting, something else this week that was interesting, as I was reading the Wall Street Journal, I saw an interesting article talking about Buzz Aldrin and how, unfortunately, it looks like he might be the target of some elder abuse. And unfortunately, it appears to be from his own family. He's actually suing his own family. And I was reading this article, and basically what's happened is that Buzz Aldrin, who a famous astronaut, of course, he has hired a business manager to help kind of take over his enterprise, his foundation. And then one of his children also was a partner of this enterprise, his foundation. And as he was starting to kind of turn more things over, it looks like he might have turned things over to the wrong people, where now they were almost voting him out of his foundation, and they're claiming that he was lacking capacity. So they actually started a guardianship proceeding to be able to take over, guardianship and conservatorship proceeding to take over his affairs, to be able to make legal decisions for him. And the sad thing is it seems unwarranted, because he seems to be fighting back, and he actually sued his business manager and and child for elder abuse, saying that they're basically trying to take advantage of him. So I'm not sure how this is going to play out, but I was just reading that article, and it was kind of depressing. One of our national icons is going through this process, and that's why it's important that you get your affairs in order by putting things together properly. A lot of these things can potentially be avoided, but that's one of the dangerous things or the sad things. It's something that I've seen often in my practice, is just how these kind of going through the aging process and death can have interesting effects on family dynamics. And I shared in the last show just how that actually a similar situation growing up with my uncle and his 3 children, how when he passed away, he didn't necessarily have his affairs buttoned up, and it created confusion for the next generation. And so that's something that we try to avoid by having a good plan in place. And that's really what we're talking about a lot on the Chris Berry Show, is planning for that second half of life, to make sure that it's smooth and things go the way that you want, to make sure that we protect that quality of life for that second half of life. So with that, join us in our next segment. Our next segment, we're going to talk about structuring our finances in the second half of life, specifically a planning strategy. We call it the bucket plan, of how do we organize our money, how do we look at different time horizons, and how should we invest our money based on those different time horizons. And that's what we're going to talk about in the next segment. And then in the third segment, as always, we're going to answer your questions. So if you do have any questions that you want us to tackle on air, that we'll share our knowledge, make sure that we're well educated going into the second half of life, please give us a call at 810-355-2584, or shoot us an email anytime at askchris@thechrisberryshow.com. And you're listening to Chris Berry on The Chris Berry Show on FM 101.5, AM 1400, The Patriot, every Sunday at 2 p.m. And then also you can find us on iTunes, or you can go to thechrisberryshow.com, so you can listen to us as a podcast at any time, maybe while you're driving at some point. And so join us again on the next segment, where we're going to talk about the bucket plan and how it's an interesting way to organize your finances for the second half of life. This is Chris Berry on The Chris Berry Show. Join me on the next segment.
The cost of care for an elderly loved one or a loved one with a chronic illness is shockingly expensive. If you are dealing with the unbelievable cost of care, make sure you get all the benefits you're entitled to. Here's certified elder law attorney Chris Berry from the Elder Care Firm in Brighton.
Most of my clients are really concerned about long-term care costs. They don't know where to turn, and what we can do is put together legal strategies to protect your resources and also bring in additional resources to help pay that cost of care. One of the things that they often say is that I wish I knew about this years prior. And unfortunately, the information's out there, but there's just so few certified elder law attorneys. As the only certified elder law attorney in Livingston County, it's my job to make sure that our seniors, our loved ones, our veterans have the best quality of care possible and the best quality of life possible.
Protect your hard-earned assets from probate, long-term care costs, and the IRS. The Elder Care Firm will get you the governmental benefits you deserve, including veterans benefits and Medicaid. Visit theeldercarefirm.com and schedule a free 15-minute phone consultation. That's theeldercarefirm.com.
Welcome back to the Chris Berry Show, where we talk wealth, estate, and tax planning for the second half of life. This is your host, Chris Berry. And now on this segment, what we're going to do is we're going to talk about the concept called the bucket plan, which is actually part of a book that I was a contributor to. And it's an interesting financial planning approach, and think of it as creating 3 buckets of money. But before we talk about before we talk about those buckets, we need to talk about why we need to think about our money in this fashion. Because one of the biggest risks in retirement is what's called sequence of returns. Sequence of returns. So think of it like this. While you're working, you're making money, you're in what we call the accumulation phase. So you're making money, but you're not really having to take money out. You're not having to draw on your investments or assets because you have a salary. You have your wages coming in. So that's great, but what happens when we move into retirement and now we go into the distribution phase? And so one of the things that we have to realize is that the sequence of returns or the order of returns can have a drastic effect on our retirement, specifically during that distribution phase. So when we're talking about returns, think of it like this. Let's say we go 10 years, and the average return over those 10 years is 6% a year. Now keep in mind, you're not earning 6% a year. The market might go up, the market might go down. It might go up 15%, it might go down 15%. We never know what the market's going to do. But let's say on average for 10 years, hypothetically, the market gives you a 6% return. And now let's take into account two scenarios. We're going to call one person Miss Lucky, and then the other person we're going to call Mr. Unlucky. And this is going to be during accumulation. So this is while you're still working, you're still making money. And let's say we take $100,000. And that $100,000 for Miss Lucky, first let's say the market goes up 30%, and then goes up another 20%, and then 10, until the final years it goes down 20 and then goes down 30. So in that situation, we have about $150,000 if we started with $100,000. Now, for Mr. Unlucky, let's take the same example. So the same $100,000, we're going to take the same average during those 10 years of 6% over those 10 years. The only thing we're going to change for Mr. Unlucky is we're going to change the order of those returns. So instead of with Miss Lucky starting out positive 30 and then 20, 10, then ending with negative 20, negative 30, Mr. Unlucky, he's going to start off basically in a 2008 scenario where the market goes down 30%. And then the market goes down 10, and then the market comes up 10, until year 9 and 10, there's a 20% gain and a 30% gain. So for both Miss Lucky and Mr. Unlucky, it's the same 6% average return over those 10 years, but the only thing we're changing is the sequence or the order of those returns. And so during accumulation, while you're working, they actually end up with the same amount. So if you're doing math at home, that $100,000, 10-year average return of 6%, with those sequence of returns that we stated, would yield about $154,000 for both of them. So the interesting thing here is while you're working, the order of the sequence of returns doesn't really matter. Now let's change the scenario. So instead of from during accumulation, now we're going to look at your distribution phase. So think of this as after you retire, you lose that salary, you lose those wages, and now maybe you have to start drawing on your assets. So we call this during distribution. So same scenario, same $100,000. Okay, we have Miss Lucky, we have Mr. Unlucky, same 10% or 10-year average return of 6%, and then the same sequence of returns. So for Miss Lucky, we start off positive 30, positive 20, 10, until year 9 is negative 20%, year 10 is negative 30%. So for Miss Lucky, the market starts out doing very well and then ends poorly. Now Mr. Unlucky, again, starts out poorly, so think 2008, and then the market makes a rebound. So now let's look at this during the distribution phase. So both Miss Lucky and Mr. Unlucky, they have what we call an income gap, meaning they need to take money out of their assets to cover their expenses because they've lost their wages. They stopped working. They don't have their salary anymore. So now they need to draw on their assets. So in this situation, we're going to assume that they need to draw on that $100,000. They need to draw 6% a year or $6,000 per year. Okay, that's their income gap. They have an income gap of $6,000 per year, meaning no matter what the markets are doing, their expenses are going to be $6,000 a year more than their sources of fixed income. So they need to draw $6,000 a year, no matter what. Well, when we factor that in, so during distribution, when we factor in that $6,000 a year withdrawal on top of whatever the market's doing, what we find out is that if the market starts out doing well. So for Miss Lucky, where the market goes up 30%, so we take that $100,000, the market goes up 30%, yielding $130,000. Now we need to subtract that $6,000 for the income gap. That leaves $124,000. So keep going doing that. For Miss Lucky, with the positive returns in the beginning, the negative returns in the end, with this withdrawal, Miss Lucky ends up with about $105,000. Now let's switch over and look at Mr. Unlucky. So assume that you're nearing retirement, you saved up your money, now you're about ready to start making your distributions, you have this income gap, you know that you're going to cover your expenses by taking out that $6,000. So it's almost like a 2008 situation. We have that $100,000, now the market goes down 30%. We're left with $70,000. Now, regardless of how the market went, you still need to cover your expenses. So Mr. Unlucky, even though the market went down, still takes out his $6,000. That yields an ending value of $64,000. And then, unfortunately, the market went down again the next year and went down another 20% for Mr. Unlucky, yielding $51,000. You subtract out that $6,000 of expenses that you still need, yielding $45,000. Now the market starts to rebound with those 10, 10, 10, 10. And then in year 9, it goes up 20%. But unfortunately, it's on such a low balance that it doesn't have much of an effect. And then the market goes up another 30% in year 10. But for Mr. Unlucky, just by adding in that distribution phase with that negative sequence of returns in the beginning, positive in the end, they're left with only $39,000. So it's basically a $75,000 swing based on that sequence of returns. Now, if you think about it, this makes sense. Imagine yourself right before 2008, about set to retire, and then the market tanks. That's where a lot of people had to go back to work. Their retirement was screwed up based on the sequence of returns. And it's one of those things that at first you don't think about, but then when you see it in action, you're like, yeah, that makes sense. So how do we fight against the sequence of returns? Because a lot of people say, well, you can't control the market. I'd agree with you on that. You can't. But you can control your tax planning. You can control the timing of, or the use of your money. So how do we fight that sequence of returns? Well, this is where the bucket plan comes into play. So imagine 3 buckets. And in the first bucket, this is your now money. This is money that's safe, it's liquid, it's available. This is the income you need for the next 12 months. And now, while you're working, you might not have much of an income need because you have your salary or wages. But when you retire, that's that income gap that we were talking about. So in the sequence return risk demonstration that I did, that income gap was $6,000. So we need to have $6,000 of income in that now bucket. Now, for you, it might be something different. It might be $20,000 or $30,000 or $60,000. It might be something different. But you want to have your income needs covered for at least 1 year. So that's your now bucket. That's money that's safe and liquid. Then you also want to have your emergency fund or comfort fund. So if there's some type of emergency, make sure that your money is safe, liquid, and it's available. And then also you want to have any planned expenses. So any big trips or big home improvements that you're going to make, that should be in your now bucket. For example, I was sitting with a client and we're going over their bucket plan and they're talking about fixing up the kitchen and they thought it was going to be about $30,000, $40,000. Well, that money needs to be safe, liquid, and available, and that would be sitting in your now bucket for your planned expenses. So your now bucket is income over the next 12 months, your emergency fund, and then planned expenses. And then let's jump to the third bucket, and this is the later bucket. So this is money you're going to use later. And this money is geared towards growth. Typically, it's invested a little more aggressively because this is money you're not going to need right away. And then what we do is we build in what we call the soon bucket. So this is money that's safer, it's liquid. This is that middle bucket. And basically what this bucket is your first phase of income. So it might be the next 10 years worth of income. And so every year goes by, you move some money from the soon bucket to that now now bucket to cover your income gap, your expenses for the year. So it's 10 years worth of income. So you take whatever that income gap is that you put in your now bucket, you multiply that by 10. And that's going to be your soon bucket. So that's money that's safe, liquid, and each year you can move money from that soon bucket to the now bucket. So that's the first phase of income. And then also one of the things we do is we add what we call an inflation hedge, because the cost of bread is more expensive now than it was in the past. So we don't want inflation to affect our retirement either. So typically we'll take that 10 years worth of income, then we might multiply it by 25 to figure out what our, or 25% to figure out what our inflation hedge is, and then we'll have that money sitting in the soon bucket. So we have our now bucket. That's money that's safe and liquid. We can access it. We have our soon bucket. That's typically money that's relatively conservative, but it could be invested. And then we have our later bucket, and that's where we take on the most risk because we want the most growth on that. And so what that soon bucket does is basically it buys us a time horizon between our now bucket and our later bucket. So that if the market goes up or down, as long as we have that soon bucket that's typically more conservative or might not be invested even in the market, maybe in looking at insurance options, that the market's going up or down, we're not necessarily concerned because that's money in our later bucket. And we need to understand we have this thing called the pyramid of risk, that in order to get a higher return, you need to be willing to take on more risk. So typically those more volatile asset classes, volatile mutual funds would be invested in that later bucket. And then the soon bucket would be invested more conservatively. So if the market goes up or the market goes down, I'm not having heartburn because of that, because that's money in my later bucket, because I'm not going to take a distribution from that. But as I get near retirement or nearing needing this income, then that money should be safer, more liquid, maybe outside of the market. So again, think of it as three buckets. You have your now bucket, which is your income for the next 12 months. It's your emergency fund. It's your planned expenses. Then your second bucket you have is your soon bucket. So that's your income for the next 10 years. Should be sitting more conservatively invested in that soon bucket. And also this might be your income, your first phase of income in the soon bucket. And then you have your later bucket, which is money that's geared for growth. So typically invested more aggressively. Also, we call it, it's legacy money too. And when we're talking about legacy money, we're not just talking about money for beneficiaries or their kids. We're talking about for a surviving spouse. Because what happens if you're a married couple and one spouse passes away? Well, a lot of times you're going to lose at least half of Social Security, a pension. Expenses typically don't go down much. And then what else happens? A lot of times taxes go up because instead of married filing jointly, you have a single individual now. And because those taxes go up, now Social Security might get taxed. So when we're talking about legacy planning, we're not just talking about planning for the next generation. A lot of times we're talking about a surviving spouse. So that's the bucket plan. And we find that it's a great foundation to start the financial planning process because it organizes how we utilize our assets. And as you can tell, we haven't really talked about any type of specific investments, or even really talked about any asset classes. The great thing about the bucket plan is it's a holistic process to identify how are we going to use our money, whether it's in retirement or even pre-retirement. So I'm a big fan of the bucket plan in terms of understanding how we utilize our money, and I find it's one of the best ways to fight against that sequence of return risk because you insulate yourself with that soon bucket of money. So if the market goes down, you may not be affected, as Mr. Unlucky was in our example. And so if you want to learn more about the bucket plan, feel free to visit our website at thechrisberryshow.com. You can also shoot us an email if you have any questions on it at askchris@thechrisberryshow.com. Or give us a call anytime at 810-355-2584. And join us on the next segment when we're going to get into your questions and answers. So I have a good number of questions submitted this past week that I want to get to. Hopefully we can get to all of them. If you do have a question, feel free to email us at askchris@thechrisberryshow.com. And this has been Chris Berry on FM 101.5, AM 1400, The Patriot. And you can find The Chris Berry Show on iTunes and listen via podcast anytime. Join us on the next segment.
Certified elder law attorney Chris Berry from the Elder Care Firm in Brighton can help you protect your assets from the cost of long-term care, and they can also help you with estate planning, like they did for Linda Emerson.
I had to redo my will. It weighed on me that I hadn't changed it. I wanted to make everything easy for my daughter whenever I do keel over. But I went in, it was very professional, and sat down with Chris. I would definitely suggest him because he knows his stuff and he's not aggressive. He's, very friendly and makes you feel comfortable because I think he realizes it's not a comfortable thing for people. It was just an easy process. I came out of it and I told my daughter, "It's all yours, kiddo."
Hello, I'm attorney Chris Berry. The Elder Care Firm is here to help you and your family find solutions. Call us today.
Visit theeldercarefirm.com today or call 810-214-3800, 810-214-3800.
Welcome back to The Chris Berry Show. This is Chris Berry, where we talk wealth, estate, and tax planning for the second half of life. And in this segment, we're going to get into some of our listeners' questions and provide some answers. Now, keep in mind, this is just general advice. Make sure to sit down with a professional if there's something that you want to act on. One of the best ways to get started, if something that we've talked about on the show triggers something in you, is to attend one of our workshops, which you can do by visiting thechrisberryshow.com, and you'll see a list of our upcoming workshops there. So, getting into the questions, here's our first question of the week. So how do I know if a particular mutual fund is right for me? And this is from Brock. I'm a new investor. I have some insight on stocks, ETFs, options, and other investment strategies, but I'm currently looking into mutual funds as another source of investment. How do I evaluate the funds and actually make money off them and apply this knowledge to other investment goals? So that's a pretty detailed question, Brock. I can't really give you any specific answers with regards to your planning without walking you through our best interest holistic process. But that said, I can speak on mutual funds. And so one of my core beliefs is that you can't control the market. The market's going to go up and the market's going to go down. And I don't think that you can really pick stocks or say that this mutual fund is going to outperform that mutual fund. I believe in what's called the efficient portfolio theory, that no person in Metro Detroit really can pick stocks better than someone else. There's going to be certain situations, and just by the number of people participating in the market, there's going to be ups and downs, and there's going to be winners or losers, just like there are at the blackjack table. But long story short, I believe in the efficient market theory that the market's going to go up and down over time. It's shown to go up, but I can't tell you whether it's going to go up or down tomorrow. So then if we can't control the market, then I look to the things that we can control. And this is just kind of part of my own philosophy, is try not to worry about the things outside my control the things, worry about things I can control. So things you can control are things like tax planning. You can control how you utilize your money with that bucket plan. You can control your legal planning. Well, I can set up an asset protection trust. But you can't control the market. So my big thing from a financial standpoint is I want to minimize fees and minimize taxes through tax planning. So with mutual funds, there's a lot of kind of hidden fees that people don't realize. And so we look to mutual funds that try to keep fees as low as possible. And we have some software that can show kind of the expense ratios of different mutual funds. So I always advocate for really low fee mutual funds because the market's going to go up or down. I don't want to pay a bunch of managers to actively trade or churn that portfolio, trying to chase the latest stock tips. So I would look to mutual funds that try to keep the fees as low as possible, control the things that can be controlled. So I hope that was helpful, Brock. So getting into question 2 here. What steps, and this is from Andrew, who emailed in to ask Chris at thechrisberryshow.com, what steps do I need to take to probate my mom's estate? And so this is from Andrew. And so Andrew, I'm sorry for the loss of your mother. There are some things that do need to happen, though. And understand that there's not a lot that has to happen right away when you lose a loved one. A lot of times the funeral home takes care of notifying Social Security and getting you the death certificates. But if you do have to probate estate, there are some specific steps. But actually, hopefully, Andrew, you don't have to go through probate, because there's 4 ways that assets transition out of your mom's name when she passed away. And hopefully we can rely on one of the first 3 versus relying on probate. So the 4 ways that assets get out of someone's name when they pass away would first be through joint ownership. So if you were joint with your mom on a bank account, well, then that account is going to go to you. The second way would be through beneficiary designations. So maybe your mom named you as payable on death on a checking account, or maybe mom named you as the beneficiary of that life insurance. Well, if she were to pass, or because she's passed, and if it does pass through beneficiary designation, then it comes to you, and now it's yours. All you have to do is send in a death certificate. Third way would be through a trust. Maybe your mom had a revocable trust, and maybe the assets were titled in the trust. And then if they were, it's going to follow the terms of the trust. But if an asset doesn't pass through probate, doesn't pass through beneficiary designation, doesn't pass through a trust, then it has to go through probate. And why do I say that we want to try to avoid probate? Because it's a court process. No one likes going to court, other than lawyers. But I'm not that type of lawyer. Then also, it's costly. The national average is 3 to 5% of any assets going through probate get eaten up in costs. So I would rather you be entitled to that money than giving it to the probate court. But let's say you do have to go through probate. So the asset didn't pass through joint ownership, beneficiary designation, or trust. It's still in mom's name. So let's say mom had a savings account with $20,000 or $25,000 that was just in her name, didn't have any beneficiaries. Well, now you have to take that through probate. Or maybe it was a house. A lot of times we see it's real estate that ends up going through probate. So if mom passed away and the home was just in her name, you have to go through probate. And so what is that process? Well, first of all, you need to petition the court to open up the probate estate. And there's filing fees associated with that probate or with starting the process. So you have your filing fees, you petition the court, and then they're going to appoint a personal representative. So if mom did have a will, then that will is going to say who the personal representative is. If mom did not have a will, meaning she died intestate, then the court will appoint a personal representative. And typically it would be a spouse first, then kids. So once you're appointed a personal representative, now you have the legal authority to act. And so it's your responsibility to gather the assets. Is it a bank account? Is it a house? And then from there, you have to do a notice to creditors. You have to notify creditors that this probate estate is open. And so you have to publish notice. And typically that's done in one of the legal newspapers. And what that does is starts a 4-month process or time window where any creditors have to step forward. And if they fail to step forward after the 4 months, then that claim is barred if it was a unknown creditor. So you're cutting off any access to creditors. So that's the publishing notice. And then by statute, a probate has to remain open 5 months. So from the time you petition the court to become the personal representative, you have to keep that probate estate open 5 months. And it makes sense because you have to let that notice to creditors run, but also gives you time to gather the assets. And then once you feel comfortable that you've gathered all the assets, then you can file an inventory. And you file the inventory with the courts as well as to the other interested beneficiaries. And basically that inventory is going to be a list of the assets that are going to pass through probate. And then with that inventory, not only do you have to fill out the inventory, but now you have to pay an inventory fee to the courts. So based on the value of all those assets going through probate, now you need to write a check to the courts that easily could have been avoided had mom avoided probate. And then once that inventory fee has been paid, once the 5-month statutory time frame has passed, then you can look at closing the probate estate. So you need to see what the will says in terms of distributions and make sure you've paid off any of mom's final expenses. But then once you're comfortable or confident that all the bills have been paid, then you can look at making distributions. So if you were the only beneficiary, then it's pretty simple. You just transfer the assets with a death certificate and the letter of authority you've received from the court to put the asset now into your name. If there's other beneficiaries, then you need to split it up per the terms of the will. And then if there is no will, then it's dying intestate. And basically it's the state of Michigan has created a will for you or for your mom. And basically it says it goes to spouse, and then if not spouse, kids. So that's the probate process. Hopefully you're able to avoid that with your mom, because hopefully she relied on either joint ownership, beneficiary designation, or a trust to handle the administration of her estate. But if she didn't and you have to go through the probate route, hopefully that was helpful for you, Andrew. And if you want to learn how to avoid probate, that's where you should attend one of our weekly workshops where we talk about probate avoidance or in avoiding governmental interaction with regards to planning for the second half of life in your estate. And you can learn more by going to thechrisberryshow.com, or you can shoot us an email anytime at askchris@thechrisberryshow.com. Now let's get into our next question. This question's from Mark. So how much can I expect to pay taxes on a $160,000 IRA withdrawal? And this is from Mark. My wife and I plan to use our IRA to purchase a home. The amount we'll use from our IRA is $160,000, and we are first-time home buyers. So the question is, how much should I expect to pay in taxes? Well, there's actually two pieces of this, Mark. The first part, and I can't really give you an answer without knowing more details, but with the IRA, and I'm assuming this is a traditional IRA, meaning it's pre-tax dollars, there's two pieces to this. First of all, there might be a penalty. And the penalty is because you might not be 59 and a half. And that's one of the things with retirement accounts is that if you try to take the money out prior to 59 and a half, you may have to pay a penalty. Now, there's certain exceptions where you can avoid that penalty, and using it as part of a home can absolve some of that. But you might have a penalty on that. And then the second piece is calculating the actual tax. So if it's $160,000 pre-tax, then what we have to do is we have to figure out how much you're going to pay in taxes by looking at the amount of income you already have coming in. And the way the tax rates work is it's a graduated cylinder. As you pour more income into that cylinder, your marginal tax rate goes up. Now, that's not your effective tax rate, it's your marginal tax rate. So let's say you pull out $160,000. So that's just $160,000 of income. Well, if you work or if you make $5,001 more, you're going to be in the 24% tax bracket. Now, that's not to say that 24% of your income is going to get taxed, but what it is saying is that you've reached the 24% marginal tax rate. So the way the tax rates work is it starts at 0 and then goes to 10 and 12 and 22 and 24. So as you're going up in income, you're paying at a higher marginal tax rate. So that'll take you to the 24% marginal tax rate. So it's kind of complicated. A lot of times people will, I'd recommend exploring other ways other than using your retirement accounts to fund that home purchase. But it's a little bit of a complicated question there, Mark. All right, so let's go on to question number 4. So question number 4, can you dismiss a ladybird deed? And this is from Jillian. I made a ladybird deed and included my siblings. Now I want to sell, but I am concerned one of my siblings won't sign off. So Jillian, just need a little bit of a clarification on the question. So it might be a very easy solution or it might be more complicated. So typically a ladybird deed is a form of warranty deed or quitclaim deed that says it's in your name while you're alive, and then if you were to pass away, or I guess when you pass away, because we're all going to pass away at some point, when you pass away, that home, that piece of real estate goes to whoever you've named on that ladybird deed. So it's almost like a beneficiary designation for your home. So you can do whatever you want with it. You can sell it while you're alive. But if you own that property when you pass away still, then it goes to the people that you've listed as beneficiaries. So Jillian, if you made a ladybird deed and you said that once I pass that it goes to your siblings and now you want to sell, you have no problem doing that because your siblings have no interest in the property until you pass away. Basically, it's yours to do what you want while you're alive, and then if you pass away owning that property, then it goes to the siblings. So if you do truly have a ladybird deed, then that's great because they don't need to sign off on anything. Now, if you truly have joint ownership and not a ladybird deed where you've named them as joint owners with you while you're alive, that's a completely different situation. Then they would have to sign off on you selling that property. So that's one of the reasons that we say that joint ownership is great for a married couple, but I would not recommend naming anyone else jointly on a piece of real estate, specifically for this reason. So Jillian, if it is joint ownership, then you're going to have to get your sibling to sign off or you're going to have to take them to court. If it's truly a ladybird deed, then that's the best result because you can just deed it and sell it without any signature or any type of input from them because they don't become owners of that until you pass away. And so I think that question is important, that there's a lot of details in something as simple as just transferring a piece of property. And we talked about it a little bit last show of just missing the words with rights of survivorship completely changes how a piece of real estate is handled. So it's important to sit down with a professional, a qualified professional when you're planning for the second half of life. And so this has been Chris Berry on The Chris Berry Show every Sunday at 2 p.m. on FM 101.5, AM 1400, The Patriot. Join us next week where we're going to talk about some key tax changes that have happened this past year. Taxes being one of the things we can't control what the tax rules are, but we can control our tax planning. So we're going to get into that next week, talking about some of the key changes from the new tax laws. And then, as we do every week, we're going to have one segment talking about those new tax laws. And then the third segment next week, again, we're going to get into your questions and provide you some answers. So if you do have any questions, give us a call at 810-355-2584 or shoot us an email anytime at askchris@thechrisberryshow.com. And you're listening on FM 101.5, AM 1400, The Patriot, to The Chris Berry Show, where we talk wealth, estate, and tax planning for the second half of life. And I look forward to joining you next week. Make it a great week. Have a happy 4th of July.
Learn more about Chris Berry and the Elder Care Firm by visiting online at michiganestateplanning.com. That's michiganestateplanning.com. You can also call Chris Berry at 888-390-4360. 888-390-4360. This program content reflects the opinions of Chris Berry and his guests, not the Elder Care Firm, Prosperity Capital Advisors, or the C.J. Berry Group, and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment or legal advice or a recommendation regarding the purchase or sale of any security or to follow any legal or tax strategy. There's no guarantee that the strategist's statements, opinions, or forecast provided herein will prove to be correct. Past performance is not a guarantee of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses, which would reduce returns. All investing involves risk, including the potential for loss of principal. There's no guarantee that any investment plan or strategy will be successful. We recommend that you consult with a professional dedicated to your needs. This program is furnished by the Elder Care Firm.
If you or a loved one is facing long-term care costs, make sure you talk with certified elder law attorney Chris Berry from the Elder Care Firm, like Jennifer did from Howell.
This past summer, my mom had to transition into a nursing home. So we contacted Chris to help get things in order. You know, I wanted the best. I wanted somebody who knew what they were doing. Chris was able to help save a lot of that money that my mom and dad both worked so hard for. I thought that everything would have to go to the nursing home, but it didn't. He was able to save us half of everything that would have gone if we hadn't contacted the Elder Care Firm. And we're all happy about that. Don't go to the nursing home without contacting Chris first.
Hello, I'm attorney Chris Berry. The Elder Care Firm is here to help you and your family find solutions. Call us today.
Protect your assets from probate, long-term care costs, the IRS, and get the governmental benefits you deserve. Visit theeldercarefirm.com today or call 810-214-3800. 810-214-3800.